Hey there, everybody. Welcome to Yahoo Finance Live. Merry Christmas Eve, or Happy Festivus, as we call it. That's right, Jared Blickery, my favorite holiday. We will have airing of the grievances later on. I'm Dave Briggs. Let's get you up to speed on Friday's market action. Well, we saw some big losses yesterday, clawing some of those back, and look at that. We're all in the green on this Christmas Eve, albeit just barely, not a ton of market action. Let's get more now with Jared Blickery taking a deeper dive inside the action for the week, my friend. Hello.
Yes.
Nice jacket, brother.
Hey, I appreciate that. Woo, I really do. I get to wear this, as I joke, twice per year. Valentine's Day, 2 months coming up as well. Hey, can't beat that.
Sharp.
Thank you. We got some econ data today, kind of a data dump, and I want to go over this. First, as Dave said, we got all the majors in the green, although only slightly. Here's the E-mini S&P 500 futures. The futures so that we can see what happened at 8:30 a.m. If this looks like a bunch of sideways action to you with not really much going on, that's because that's exactly what's going on. 0.5%, not that much action nowadays. Nevertheless, we got a spike around some inflation data we got. That's a PCE deflator along with the core number. Now, these are the Fed's favored inflation numbers, although they don't always move the market. Now, so headline inflation remained the same at 5.5%. When you take out food and energy, that bumped up to 4.7%. That's the number you're seeing on your screen. And because that came a little bit out of consensus, we did see some price gyrations there. Then at 10 a.m., we got some more data on the inflation front. First, University of Michigan consumer sentiment. That's tracks consumer sentiment. That has its own inflation expectations built in, which came down. So you can see the headline number beating expectations, 59.7. And then the other numbers you want to go on to come in on the downside. 1 year inflation, that ticked down to 4.4%. 5 to 10 year inflation, 2.9%. We also got some home figures out at 10 a.m. I don't think these moved the market much, but nice to see 640,000 new homes there, as you see on your screen. That's up 5.8% for the month. And that's in an environment, Dave, we've been talking about just brutal for the housing market this year, but not today.
Yeah, it's been a very rough week for housing data. It has been ugly, and we will talk more about that later in the program. But first, let's get up to speed now on the frightful weather outside. A bomb cyclone, whatever that is, grinding its way across the country ahead of Christmas, resulting in more than 7,000 canceled flights across the world. That's according to FlightAware. And the situation is likely to worsen in the hours ahead. So what to do if you are traveling? Mike Boyd is the president of Boyd Group International. He joins us now. Good to see you, sir. 190 million Americans under some type of winter weather advisory. Most of those airlines have staffing shortages. So how bad could things get?
Well, this is one where you got to sort of just sit tight and suck it up, because we can't do a whole lot about it when an airplane is stuck in Minot, North Dakota, can't get into Chicago and has to cancel. Those are really tough things you have to do, but let's be blunt. It's more than 190 million. I'm in Colorado, where we are not affected up here in the mountains. It's a beautiful day, wonderful skiing, except there's nobody here because nobody can get here. So businesses across the entire nation are being affected, and Grandma is not getting into Utah this morning from New York. It really is a nationwide hit.
And Mike, how far is this extending into the new year that you're seeing? I know we got another week left. We got some holiday festivities here, but looking ahead to January, are we seeing some potential problems there as well?
I don't think so. I think once this passes, it'll take a little bit of time, maybe 36, 48 hours for airlines to get back to some semblance of operational normal. But I think, a week from now, this is going to be a very nasty memory for most of us.
Jared's going forward, I'm going back. Mike, I'm always wondering why they start canceling flights well ahead of this storm. They cut a couple thousand on Wednesday. Why do the airlines do that?
Well, they don't want to have an airplane somewhere where they can't get it out. For example, if they see an ice storm is going to be in Dallas, for example, they'll cancel the flight that's going into Dallas the night before because they don't want it to get stuck there. So it's the issue is they're trying to be proactive in terms of how many people really get badly hurt for the long term, because they want to keep their fleets flexible. So canceling ahead of time usually is a smart move in most cases.
And I was reading the Tennessee Valley Authority basically announcing rolling blackouts this week. In terms of the geographic distribution of this problem throughout the United States, do we have some hot spots that are more adversely affected than others?
Yeah, I mean, it's somewhere in scripture that the only time you're going to have bad weather is Friday afternoon over the hub at Chicago O'Hare. But any place where you have a place like Chicago O'Hare, Charlotte, Dallas, Fort Worth, that's where all the airplanes come in, hub, and go out. And if that gets shut down, which they do get shut down, it's chaos it's a problem through the rest of the system nationwide and in some cases globally.
How does the fact that we have fewer flights actually make this a bigger mess? Does that mean the flights are actually more full and fewer options to rebook throughout the holidays?
Well, there's fewer options to rebook. There's no question. We're still below 2019 levels and probably will be just naturally because there's changes in consumer patterns. But I think overall, you do the best you can. But the fact is we're in an electronic industry today. And like one airline, a number of airlines have gotten rid of their call centers only because it doesn't do any good. Everything's electronic. So the real issue now is to rebound from these kind of problems. It means both sides of the telephone and both sides of the internet have got to be understanding of the situation. The consumer isn't going to see grandma this Christmas, and the airline isn't going to be able to operate. Both are ticked off.
Mike, I want to take a 30,000-foot view here of the situation, just kind of back off the weather problems. We've had a number of changes over the pandemic in terms of people's traveling behaviors. We have business finally starting to come back. Wondering what kind of trends you've seen evolve over the year that might carry over or might start a new trend into 2023.
Well, I think, look at it this way. A lot of the business travel has gone permanently because, put it this way, if it's a meeting that does not require a handshake, you don't have to have travel to do it. You can do it electronically. That's probably 15% of what was there before the pandemic. So we see that coming along. A lot of short haul flying. I mean, let's face it, a lot of small communities, despite what some Washington organizations are telling us, they're never going to see air service at the local airport again. Like, Toledo doesn't have connective air service anymore, except 1 hour away in Detroit, they got 300 flights a day. So the way consumers are going to be traveling is going to be a little bit different going forward.
Mike, I can't help but notice as I'm on FlightAware right now, seeing American, United, Delta, all around 9 or 10% cancellations. But you look at Southwest and Frontier, well over twice that, both of them at 22 and 23%. Anything to that? And are some of these airlines better equipped? Have they handled the pilot and staffing shortages better than others?
Well, I think, they've all, look, we've never had an airline industry as well managed as we do today, real bluntly put. But the fact of the matter is, it's where they fly. Keep in mind, a lot of the travel that Southwest has is on the East Coast. That's been heavily hit. Frontier, the same thing. It's a very vulnerable system because they're spread out around the country. So you can't compare one airline to another because their operational systems are very different. But I think they're doing the best they can. That doesn't mean it's as good as it could be or should be, but they're doing the best they can because this is something that is not just a meltdown of the airline industry. We have a weather meltdown and we're trying to get through it.
I'll try to keep that in mind when I'm flying on Christmas morning. Where are you hitting the slopes this weekend, Mike?
Oh, Vail, come out here. Vail, Aspen, it's top notch, and we're not affected by the bomb, if you will. So come on out and come skiing.
That is my home, my friend. Enjoy the white stuff. Can't wait to get back there. Mike Boyd, good to have you on, my friend. Merry Christmas.
Thank you. Same to you, sir.
All right, a government shutdown is officially averted. The House of Representatives passing a bill to fund the federal government for the rest of the fiscal year. It now goes to President Biden, who has said he's eager to sign it into law. The legislation provides $772 billion for non-defense discretionary programs, $858 billion in defense funding. It also contains $44 billion for Ukraine assistance. The bill is seen as a bipartisan win for President Biden and the final achievement for House Speaker Nancy Pelosi, who plans to step down from leadership in the next Congress. All right, we're just getting started here on Yahoo Finance Live. Coming up, the S&P 500 heading for its third straight down week in what has been a brutal year for stocks. Our next guest tells us the biggest risk for markets heading into 2023. And a media madness, billionaire Michael Bloomberg might be setting his eyes on a new target. We've got the details on the other side of the break.
Markets in the green on this Friday after another volatile week with the S&P 500 heading for its third straight down week. And for a deeper dive into the broader markets, we're joined by Frances Newton-Stacy. She is a director of strategy at Optimal Capital. Always great to see you here. Want to ask you about our current situation, what you expect for the new year. It's been an incredible, we've talked about this a number of times over the year. We've been surprised, but what should we expect going into 2023?
Yeah, so 2023, basically the pivot trade is pretty much all but in. If you look at the reversal in the dollar, the reversal in gold, the reversal in silver, the reversal in the 10-year, not today, but generally speaking, and the reversal in bonds, even though they're selling off today and they sold off yesterday. The thing about it is that's already in place. That is going to de facto loosen financial conditions in the wake of the Fed remaining hawkish. We now just have the House passing this $1.7 trillion fiscal plan. And depending on when that money is coming into the system, that's going to have to be weighed against the balance sheet money that's coming out of the system, which Powell has said in his last press conference that he's going to continue taking the money out of the system. Taking the money out of the system is what increases the credit risk. And that's what we have to watch for in 2023. So far, it looks like a soft landing, but I would argue that all of the rate hikes and the balance sheet adjustments haven't yet worked their way through the system.
Really nice to see Congress exercise some fiscal discipline, isn't it, with that $1.7 trillion tight package? Frances, when you say a hawkish Fed, are you expecting a 25 and a hold?
Probably. That's about what's priced into the market. But you know what I'm really interested in is what he does with the balance sheet, because the S&P 500, if you overlay an S&P 500 chart on the balance sheet, they track quite perfectly. We have an infinite number of variables, but there are a couple of very key variables that tend to trump other narratives. And the balance sheet, based on empirical evidence, does just that. And while there are silver linings, as long as we're reducing liquidity in the system, that's going to put pressure on equities. And I see that continuing to happen. We're also tracking right now to potentially see negative growth in the first quarter of next year. The labor market is starting to soften a little, albeit still very strong. And so these things and the recession narrative and the fact that inflation has come off of its peak, which was confirmed this morning yet again with new numbers, now we're entering the disinflationary, where inflation and growth are decelerating simultaneously. That's taking over from the stagflation. And that has its own set of circumstances that we're likely to see play out in 2023, unless the Fed changes its course.
All right, Frances, so how is this going? How do you see this playing out in the equities markets? I'm looking at some of your picks here, and they look a bit defensive, including ITA, which is defensive in a different way. It actually tracks defense stocks like Lockheed Martin. But just kind of break down, if you could, some of these tickers that you're looking at.
Sure. So defense stocks, that's the geopolitical risk, the hedge against the geopolitical risk. Obviously, we've got the ongoing war in Ukraine. We have sort of whispers about, potential conflicts with Taiwan and China, and that's not my area of expertise, but it looks like a great place to invest. Utilities, healthcare, all things that are prevalent in today's society that are going to probably sell off relatively less than other equities that have, big exposure to rates or big exposure to liquidity drops, et cetera, et cetera. And so it's basically a defensive play. Those are sectors that work well in that disinflationary environment historically. And because we're still taking money off the balance sheet, even though we have the pivot trade that's already occurred, I do think that the defensive sectors are going to play out a little bit better to start 2023. Now, that being said, if the VIX goes north of 30, all bets are off, all correlations go to 1, and everything seems to sell simultaneously.
All right, we're going to have to leave it there. Frances Newton-Stacy, good to see you. Merry Christmas to you.
Merry Christmas.
All right, billionaire businessman Michael Bloomberg reportedly looking to expand his media empire. Axios reporting Bloomberg is eyeing either Wall Street Journal parent company Dow Jones or the Washington Post, which is currently owned by Jeff Bezos. Ali Canal joining us now with the latest. Ali, what are we learning?
Yeah, that's right, Dave. And according to this Axios report, Bloomberg is most interested in that Dow Jones acquisition due to its all-encompassing business coverage. You mentioned how Dow Jones is the parent company of the Wall Street Journal, but also Barron's and MarketWatch. So pretty notable franchises there, especially within the finance world. However, the report did indicate that Bloomberg would be willing to purchase the Washington Post if Bezos was willing to sell. Yahoo Finance did reach out to both Dow Jones and the Washington Post. A spokesperson for Dow Jones declined to comment, and the Post did not immediately respond. But another interesting layer to this story is the relationship between Michael Bloomberg and Rupert Murdoch. Murdoch owns News Corp, which is the parent company of Dow Jones. He is close with Bloomberg, and we did receive a report back in October that Murdoch was considering a recombination of News Corp and Fox, which last split in 2013. Bloomberg, though, at least according to Axios, believes this recombination will fail, thus creating a possible opening, although he reportedly has not yet spoken to Murdoch about his interest. So seems like this is still very early days, but definitely something to watch heading into 2023.
And Ali, thinking about what else in the M&A space may happen in media in 2023, I'm just wondering what's on your radar, because if I think back over the last 20 years, it seems like there's a major reshuffling about once every 10 years that kind of occurs with the business cycle. You see a bunch of combinations, a bunch of split ups. What are we seeing for the new year?
I think we're definitely entering that period, Jared. There are signs that there's going to be more mergers and acquisitions in 2023. We've seen this push to profits, increased competition, companies just bleeding money, especially those traditional print entities. And M&A is often looked at as a viable solution to those problems. Of course, the interest rate environment, that could create some headwinds, but Wall Street is going to be on all of these companies' tails amid that profitability push. So other possible acquisitions to look out for could include Paramount Global unloading, along with some of those smaller players like WWE, Curiosity Stream, Chicken Soup for the Soul, and then Disney. What are they going to do with Hulu and ESPN? So there is certainly a reckoning across the industry. The stock market has wiped $500 billion plus off of the media sector this year alone, and everything's on the table when it comes to this industry to try to recover from that and survive in the new year.
All right, Ali Canal, good to see you. Thanks so much. Jared, do you have any predictions for any of these media M&A acquisitions we could see next year?
I have a big focus on Microsoft right now. Why Microsoft? Because they have partnered with Bloomberg. This is a report I just read a week or two ago. Bloomberg, we know, huge in the media. I mean, we're just talking about Bloomberg right now. Actually, I got that wrong. Microsoft in a partnership with the London Stock Exchange. Now, the London Stock Exchange bought Refinitiv, formerly known as FactSet, kind of a competitor of Bloomberg. And if you put this behemoth Microsoft next to the London Stock Exchange with the FactSet, with the Refinitiv data set in there, that's a credible threat to Bloomberg. So I'm not surprised to see the ante getting upped here.
That's interesting. I'm eyeing ESPN. What is Disney going to do? Are they going to spin it off like I said? I don't think they will. I think it's the stickiest asset they had. I think they're going to hang on to it. Great Reuters piece about the theoretical Microsoft purchasing Netflix, which I would just love that.
There's another one.
That's some juicy stuff. All right, we'll see.
We got to go here, but crude awakening, oil prices jumping after Russia says it may cut production. We're chatting commodities on the other side of this break. Welcome back. Russia threatening to cut oil output by up to 7% or up to 700,000 barrels per day in response to sanctions and price caps placed on Russian oil in response to the country's invasion of Ukraine. Oil trading, we can see that's up about $2.76% today, up about $2 and change, just closing in on that $80 per barrel price level. Now we have Scott Bauer, CEO of Prosper Trading Academy, joining us. And Scott, I was just reeling off the latest price of oil here. We bounced off 70. Now that's basis WTI here. We had, and I think that was earlier in the month when we were first getting those actual sanctions by Russia plowed on. And now we really didn't see much of the way in negative price action from there. In fact, we're up about $8. Just wondering how you're viewing the oil market in response to this latest news.
Yeah, I have been bullish oil ever since we've started dropping below 100 and buying it on every dip, selling it on any sort of rally here. I've had to get stopped out a couple times, but $70, $71, Jared, that really to me is a short-term bottom. When I say short-term, I'm saying at least 6 months. The floor is put in for a number of reasons. First off, that's where the administration has said, we're going to replenish SPR if we get down there. So to me, that is, somewhat of a floor. Also, I think there's just still a tremendous amount of tailwinds in the space here. Number one, as it has been for me all year, is what's going on in Russia, Ukraine. Number two is what's going on in China. And I believe that the oil market anyway, has seen the worst case scenario in terms of demand, in terms of lockdowns, even with the latest, policy that they've talked about with kind of opening back up and people getting COVID. I think we've seen the worst in terms of demand. It's only going to get higher from here. So there is just a bunch of tailwinds, and that $70 number to me because of the SPR, that absolutely is a floor.
Yes, President Biden talking about buying oil at $70 per barrel for the SPR to replenish it from those from the lower levels that it's fallen to. Now, you mentioned the double whammy this year, and we were talking about price bottoms. What about a ceiling? What would it take to see a ceiling in terms of the news flow, in terms of price action? What are you thinking about as you think about those upper targets here?
It absolutely would not surprise me to see oil back in the 90s with a 9 handle. To break 100, though, I think is going to be a real tough job. I just don't see any scenario other than some more major geopolitical conflict that we're going to see oil just get to those prices again. And listen, that's not out of the question, unfortunately. That can happen. But I think this range of the low 70s, probably to the mid 90s, is somewhere we're going to be for, at least the first and second quarter of the year. All
right. And what about natural gas and some of the other elements to the energy sector? We've seen natural gas prices drop off quite precipitously. That has its own supply and demand aspects, but maybe you could just comment on that market a little bit.
It absolutely does. And in fact, if you're looking at what's going on in Russia right now and the news that they, announced that they might be pulling back, production here, that is really just for crude and oil products. It is not for natural gas. So I know that especially in Europe, there has been a shortage, but right now, I'm not going to say it's fine, but the natural gas supply right now is not as dire, if you will, as what we're seeing on the crude side. And again, if we turn back to Russia, 40%, almost 40% of all of their export revenues are from the oil space, not from natural gas. So natural gas is still flowing. I don't see that we're going to get a major spike again, certainly not to where we were. UNG, which I track very closely, is trading right around 15.5, 16 right now, which is a low we've seen in probably 3-4 months. That was as high as the mid 30s just a couple months ago. Maybe we see a 15, 20% pop in natural gas from here just because of this massive sell-off that we've had. But I don't think that we're going to get into the crunch like we might get with crude.
Well, we've been talking about the Russian, the Russian effect on crude oil supplies. It seems to me when this hasn't had necessarily bearish price action consequences when we talk about crude oil this year. And I think part of it comes from the fact that we have dark supply, so that you never see oil taken off the market considerably. You see a market clearing price. So at some price, somebody's going to take Russian oil off the market. Just wondering, with all the sanctions in place, with all the eyeballs on this, what are the potentials for violations of that next year? What are some of the situations that could evolve that could actually be bearish for the price of energy that might not be factored in right now?
So in all honesty, there's probably violations going on right now, and there will continue violations going on. Some of that's just going to be, let's call it, glanced over. But we're not going to see, in my opinion, the price get much below 60, which is that price cap there. Maybe we'll see it a little bit, but that is a number that G7 came up with to hopefully reduce Russian export revenue, but a price high enough to keep it flowing to the market. So yes, there's always some underhanded deals out there. And when you're looking at really the 4 countries that are really still in the market buying Russian oil, you're looking at Bulgaria, China, India, and Turkey. You got to think that there's be some violation there.
Yeah, I love doing a deep dive on the oil market and the futures markets on the day before Christmas Eve here. Thank you for joining us, Scott Bauer.
Thanks.
Coming up, bail granted. Sam Bankman-Fried is released on a $250 million bond, one of the biggest bail amounts in U.S. history. How did this happen, and what are the next steps? Our legal expert breaks it all down next. The FTX saga continues. Sam Bankman-Fried was released on a $250 million bond and ordered to stay at his parents' house in California. Following his first appearance in New York federal court, SBF has become the poster child for the recent crypto collapse. But should government regulators like the SEC share the blame? Former SEC senior trial counselor Howard A. Fisher joins us now. And Howard, thank you for joining us here. What's your
pleasure.
What's your assessment of this situation? It's been a show, so to speak, so far, but now we have witnesses, we have extraditions. How do you see this playing out?
Well, that's a good question. I think it's important to note that in announcing the plea bargains of Ellison and Wang, as well as the charges against SBF, the U.S. attorney issued a warning to anyone else involved in the case, involved in Alameda, involved in FTX, saying, you better come forward now. We're happy to cooperate with you, but we're coming after you. We're going to get you. Now is your best chance. So I think what we're going to likely see is a bunch of other players coming out of the woodwork, a bunch of other charges being filed, and not just by the U.S. Attorney's Office, but by the CFTC as well as the SEC as well.
Kudos for the DOJ, the SDNY, getting cooperating witnesses and moving at lightning speed. But as you know, a lot of fingers have been pointed at the SEC, including by Congressman Tom Emmer. He says Gary Gensler must testify before Congress. He tweeted that FTX's collapse is not a crypto failure. It's a CFI, Gary Gensler, SBF situation. How responsible is Gary Gensler for, as some would say, being asleep at the wheel during all of this?
Yeah, it's sort of ironic that Representative Emmer is blaming the SEC when earlier this year, if you remember, Emmer was the lead signatory on a letter by several congressmen to the SEC, yelling at them essentially for exceeding their mandate by, among other things, seeking information from FTX. Emmer is the co-chair, I believe, of what's known as the Blockchain Caucus, and he has been very vocal that government should leave crypto, should leave the digital asset space alone, and let entrepreneurship and let innovation thrive without the, as he would put it, regulatory touch of regulation. So it is somewhat opportunistic for Emmer, who has been calling for the SEC to step back, to now come forward and say, oh no, the problem is the SEC hasn't been aggressive enough.
That's fair. Should Gensler, though, testify before Congress, is there some type of regulation that could have prevented this?
Yeah, no, look, I think that there has been long a call for regulation of the crypto space, and there's, even in the face of efforts by those such as Emmer to pull back on government regulation, and it's not just an SEC issue. I mean, as you know, I'm sure, the SEC has been going after crypto assets. It has put forth several very aggressive lawsuits arguing that certain assets like Ripple, like LBRY, are in fact securities and have to be regulated. But it's not just an SEC issue. It's also a banking issue. There's now a question, given what we've seen with FTX, with Celsius, with other exchanges, there is an issue as to how crypto assets of customers are to be treated at an exchange. Should they be segregated? Should they be insured? Should there be something like some kind of depository scheme like we have for normal banking? Do we need a kind of Glass-Steagall for crypto, where customer-facing operations have to be completely divorced from proprietary trading? I think if we had something like that in effect, we probably wouldn't have seen the scope of the scandal that we're seeing at FTX.
We've been talking about a lot about the SEC, but there's also the CFTC, the Commodity Futures Trading Commission. In fact, two former commissioners made it onto the FTX board, Mark Wetjen and also Jill Summers. And I haven't seen as much written about the CFTC influence on FTX. And in fact, Sam Bankman-Fried was lobbying the CFTC to allow derivatives trading to, I guess, new futures instruments to be traded by FTX. And I got to say, I'm glad these didn't come to fruition here, because that could have been an absolute nightmare. I'm just wondering what the CFTC's complicity in this is, if you see any.
I don't think complicity is the right word here, but you do point to an important issue, and that is, if we are going to regulate the cryptocurrency space, who's going to regulate it? Is it going to be the CFTC? Is it going to be the SEC? Is it going to be another organization created just in the crypto world? And historically, the CFTC has not been funded as well as the SEC. It has been less active, less aggressive. So traditionally, if you want the approval of regulation, but you don't want to be too closely regulated, you would try to get regulated by the CFTC, not the SEC, especially since, as we've seen now with Chairman Gensler, the SEC can be very aggressive, and you don't see that level of aggression and expansion of authority with the CFTC. And I think that's why a lot of people, Sam Bankman-Fried among them, have long sought, if it is going to be a regulated space, to have the CFTC be the regulator.
It's going to be an interesting road. Please come back and join us when we get to this trial. Thank you, former SEC Senior Trial Counsel Howard Fisher. Good to see you, sir.
Thank you very much.
All right, COVID-0, a distant memory. In China, as nearly 37 million people may have been infected in one day this week. Anjali Kamlani is here with more on the explosion of cases and what China's National Health Commission is now acknowledging. Boy, it is out of control now.
Yeah, that's right. So we know, of course, that the removal of the zero COVID policies has been a problem and a concern for many, not just here, but also globally. So now what we have is China's National Health Commission admitting that at least one day this week, there were 37 million cases, blowing well past those estimates of 1 million or 3 million per day that we saw from some reports, estimating as much as maybe 3-point-something million by January. But right now what we have is a surge that is blowing well past that. The death rate, we know, is also something that we have to watch out for because China has changed what the definition is of a COVID death. So that could lead to a potential undercounting. We've had the World Health Organization officials talking about that and specifically pointing to, whether or not these numbers could match up. So World Health Organization Mike Ryan saying that he thinks, quote, "I wouldn't like to say China is intentionally not telling us what's going on." But then he also adds that the limiting diagnosis of what deaths from COVID count as could be undercounting, this very issue. So that's a concern. We also know that China has acknowledged that at least 250 million people have been infected since the start of the month. But we have to take a step back and really look at the timeline, right? We know that when the Party Congress started in mid-October, there was absolutely no indication from President Xi that this zero COVID policy was going to be removed. Then we saw quarantining kind of relaxed for inbound travelers. Then the real drama starts. November 25th, we see the nationwide protests erupting as a result of a fire, a deadly fire, killing more than a dozen people. Then that results in the start of what we see, as you can see on your screen, that breakdown of those mitigation strategies. In less than a month, they've all but scrapped all policies, all mitigation strategies, no testing, no tracking, no testing sites, reducing the quarantining, and then also reducing the definition of all this stuff. So really painting a really concerning picture of what's going on there. And that timeline, less than a month to just completely pull back all of a sudden, really sets the stage.
This, even if we were to believe the numbers, it seems like this is an incredible experiment and we don't know exactly where this is going to go. But are there any estimates on how bad this could get for China? Because it seems to be the opposite end of the spectrum from what they were doing 3 years ago.
It is. And actually, the concern really is globally. So right now, what we know is that the global impacts are where we're waiting to see. We know that Asian countries and India, for example, right now are really ramping up, making sure that the state and local hospitals have all the oxygen they need, all the ventilators they need, all the testing and equipment available to make sure that they don't get hit with this surge next, because they also have a big population and are also typically next in the waves. The U.S. also waiting and watching anxiously. China admitting that there's the potential of a new variant to come from this surge. So that's the other headache that we all have to, stay alert about and see. They say that, the idea that the new variant could be more deadly or more contagious remains low, but the fact that there could be a new one is on the table.
You can't help but wonder if there will be some type of travel restrictions in the new year. Just one theory out there. Anj, thank you. Merry Christmas to you. All right, coming up, the starting of a new chapter. Barnes & Noble opening up 30 new stores as the company looks to bring in more customers. We'll speak to the company's CEO about the reading resurgence after the break. And a pleasant post-pandemic plot twist, bookstores are making a comeback. Barnes & Noble reversing a recent trend over the last decade plus, planning to open 30 stores next year. Barnes & Noble CEO James Daunt with us now. James, good to see you, sir. What do you attribute the reading resurgence to?
COVID, though we were rather terrified when it struck and our stores were closed, actually turned out to be a fantastic thing for booksellers. People rediscovered reading, lots more people buying books, and more importantly, from our perspective, doing so in bookstores. And our sales have boomed since.
As someone whose kids were raised in a Barnes & Noble, this does warm my heart a bit. Who is reading more now than prior?
I think always customers of bookshops have spanned all the ages. Obviously, kids in buggies love a bookstore, as does the very oldest citizen. The real energy within the stores at the moment is with what we call young adults, so teens and people in their early 20s. That's where there's been a real boom. But you can see from my grey hair, I've been bookselling for a very long time. And in truth, that's always where the energy of good bookstores is. And I think one of the things that's been going on at Barnes & Noble is we've just improved the bookstores, and it's made them more vibrant, more lively places, particularly coming out of the pandemic when people are looking for spaces in which to meet each other, enjoy being a social space as well as a place in which to discover books.
Yeah, it's that experience economy that we're returning to, but I am shocked to hear you say it's young people. At least from this parent's point of view, social media was killing reading. What's been the impact?
No, social media has been our great friend. Instagram it causes people to pour into our bookstores. BookTok, part of TikTok, has been sensational. Posts that have appeared on that have been seen millions and millions of times and actually driven the sales of literally hundreds of thousands of copies of individual titles. So it's been a fantastic boon to bookstores. But the real question for us, or answer for us, has been that they want to do it in real bookstores rather than doing it online, which obviously favors us over our rather larger competitor from Seattle.
Yes, you mentioned that rather large competitor from Seattle. You're actually opening in 2 stores that were formerly Amazon bookstores. It's been a fascinating dynamic. David and Goliath have kind of switched places. What do you make of that change in the storyline?
I think, again, I point to my grey hairs. Retailing is a difficult trade, whatever you're selling. But in bookstores, it's also complicated. You need vocational booksellers above all. You need a lot of intuitive as well as actually sort of professional detail attached to good bookstores. And I think they frankly weren't very good at it. They're exceptionally good online, but they weren't very good at the physical spaces. And I think, that's our bread and butter. It's what we do well, us and independent bookstores who are also thriving in this environment.
And James, how will these new stores be different than the Barnes & Noble stores customers have been accustomed to recently?
Much lighter, much brighter. You've got some photographs sort of scrolling on your screens. They are very different from the serried ranks of cases that more or less resembled public libraries of the old style Barnes & Noble. These are places in which we want you to come, want you to enjoy experiencing the physicality of books and the curation that we bring to them, as well as being in a space which hopefully allows different age groups, different people to mix and enjoy themselves.
James, everybody's running out, last second shopping. Give us a couple of books to read for the holidays.
Oh my goodness, the sensation this year has been Bonnie Grammer's Lessons in Chemistry. Anyone who hasn't read the novel really should do so. And then, one always tries to tailor for one's audience. The big business book is Chris Miller's Chip Wars, which is sort of fascinating on the whole sort of dynamic with China and the way that microchips and are dominating the way that business is evolving, and particularly the conflict between the US and China over it. Fascinating book.
Terrific tips. Wonderful to have you on. James Daunt, Barnes & Noble CEO. Merry Christmas, sir.
And to you too. Thank you.
All right, coming up, a new year, a new plan. We'll tell you the best ways to maximize your retirement portfolio on the other side of the break.
Welcome back. Start of the new year is a perfect time to take a closer look at your retirement accounts. Here with some advice is Yahoo Finance's Carrie Hannon. Carrie, tips for 2023, please enlighten us.
It's time for some housekeeping. Now, here's the time of year where we're starting to hear about, hey, maybe you're getting a bonus or perhaps a raise if you've had your annual review. These are two times that you can really look at that extra cash coming in and say, what can I do to fund my retirement accounts with this? Like with a bonus, consider taking some of that. Some of it, sure, you might want to have some fun with, but take some of that and put it aside in some retirement accounts. If you can put it in your IRA, if you don't already have an IRA set up at a Fidelity or Vanguard, go ahead and do that, or Schwab. You can even contribute to an IRA if you have an employer-provided plan. But it's a good idea to set some of that aside to fund your retirement. And right now with prices low, not a bad idea to consider doing that. The second thing is if you're going to get a tax refund at the beginning of the year, you don't know that yet. Once again, that same advice there. Really consider just socking that right away in a retirement fund. This is money that is sort of mad money in a sense. And so I think if we can, try to be practical and find a way to use that money to really build your future financial security. Now, here's the other bit. If you're getting a raise, this is a time, if you have an employer-provided retirement account, can you tweak the amount that you're setting aside, that percentage? You can set aside 10 to 15% of your salary into your employer-provided plan, roughly. Can you bump it up? Maybe you're only at 8%, maybe at 10. Can you go to 12? With that extra salary, it's really a great time to really evaluate how much you can set aside. And truthfully, if you're not up to your employer match, please do that with that raise, because that's really good use for the money.
Sure.
I also think, I think these are just times to do some of that housekeeping about where's that money going to go.
And as we head into the new year, a few key things to remember if you happen to have that time with your accountant to keep in mind. What do you want to tell them?
Oh, yeah, I love that. Yeah, can you sit down and really think about, first of all, this might even be with your financial planner. How can you rebalance your portfolio, your retirement account portfolio, so you're in the best position starting the year? And also, you want to talk to your accountant, particularly if you're self-employed. If you want to open a solo 401k account, you absolutely need to do that by December 31st.
Sage advice and timely as well. Got to leave it there. Carrie Hannon, always great to see you here.
Thank you.
And coming up, we're counting down the closing bell on Wall Street Final One of the Week. Stick with us on Yahoo Finance Live. Just a few minutes away from the closing bell, and I thought we'd take a look at the closing numbers for this week on, well, almost closing, I should say. Got a few minutes left here, but the Dow is leading up about 0.5%. Actually, S&P 500 just edged up above that. Nasdaq, the laggard of the day, but still in the green, and the Russell 2000 holding in at 40 basis points. I got to say, the Santa Claus rally, it is here today. We've been talking about it all month, but surprisingly, if you didn't know it, today is the first day of the Santa Claus rally. It goes through the first 2 days of the following year. So we got all of next week, only 4 trading days, plus I believe Monday and Tuesday of the following week/year. But here's what's happening today. Energy up 3%, utilities up 1%, followed by communication services, real estate, everything in the green, although it looks like healthcare and tech, those are just barely holding on to their gains for the day. Let's just show what's happened over this 5-day weekend. Energy, we got that as crude oil knocked on $80 per barrel, although we saw it slide off a little bit. Financials also in the green, along with utilities, staples, healthcare, and industrials. To the downside, consumer discretionary been taking it on the chin all year long. The worst sector is also the worst sector of the week, along with tech. We also have real estate down 1% again for the week. And let's just check out some of our leading sentiment indicators. This is for today. We got retail. That is in the forefront. XRT is up 1.8%, followed by cannabis. Cannabis has MJ, transports, momentum, regional banks. So an interesting mix here, but the fringe sector is not participating. Meme not having the best day, down 2.5%. K-Web, those are Chinese internet stocks. ARK, that's a disruption category. Biotech. So we got some winners and we got some losers. Who's going to win throughout the rest of the year? Well, you're going to have to tune in next week for that. Let me just check in on what's happening with the Nasdaq. We saw Amazon just in the green today, but it's down 3% for the week. What I wanted to highlight here was some of the chip stocks. Nvidia down 8%. AMD, not seeing that right here. That was also taking a hit. Intel down 3%. The chip stocks, which are very cyclical, very levered to the business cycle, when they falter, Wall Street pays attention because they are leading indicators. Also Tesla. Tesla has just been a dismal failure this week. And let's check out the one-year chart. You can see down 65%. Although you take a look at what's happened in the EV space this week, you got to wonder if some of these names are finally close to their bottoms. A lot of these names down 90% for the year. Now, it looks like we got just under a minute left, so I'm going to check in on the travel sector as well and see what's going on there. And for today, we see a lot of green. Now, Carnival Cruise Lines, which reported earnings earlier this week, that's down about 0.8%. But the Booker, Expedia, that's up 2%. Booking.com, that's up 2%. And Avis Budget Rental Group, that's up 3.5%. Here's what Avis has done for the year, down 27%. But let me show you, this is in marked contrast to what they had done the previous year. They saw that huge run up into late last year and just kind of ameliorated those gains. Final bell on Wall Street right here.
Hoorah! See the Marines up there. Toys for Tots. Great organization. As we ring the bell, and here are the final numbers as the final trading day before Christmas. We did stay in the green in the Dow, S&P, and Nasdaq, with the Dow up about 0.5%. Leading the gains, the S&P up 0.59, and a gain as well for the Nasdaq, which spent much of the day in the red. For a closer look at the broader markets, let's bring in Brett Gottlieb, Comprehensive Advisor, Founder and President, and Ted Oakley, Oxbow Advisors Managing Partner. Brett, let's start with you. What do you make of this rally? Is Santa Claus here to stay for the next couple of days?
I sure hope so. I like seeing a day like this. It was there was a lot of news out there with the sentiment report and personal spending and really personal thoughts on things, and then to add it all up, they decide to pass the spending budget, which has got a bunch of Secure Act 2.0 stuff. So hopefully this is some good news and we can continue some green into this Santa Claus rally.
And Ted, I'll give you the floor here. What are you thinking about some of the news that we got today? And I'll echo Brett's point. I think it's actually good that we're not seeing a lot of vacillations in the market. I think a lot of people would be happy to just kind of walk away and watch paint dry as opposed to watching this market another week. But what do you have to say to people who are ending the year here with their 401ks?
Well, I suppose that most of them are probably down quite a bit in their 401ks because most of them don't give very good advice, honestly. So my guess is they didn't have a lot of defensive cash type thing. So if I were them and I had new money come in to 401k, I'd probably put that money in cash. But, normally, a lot of times in bear markets, I've seen quite a few of them, you don't get much of a Santa Claus rally. So you could get a few days next week, I suppose, but we're not at that stage right now, I don't think.
Boy, I guess I'm not getting the right advice either. My 401k is taking a beating. Brett, core PCE 4.7%. Change the narrative at all as far as the Fed's perspective?
No, I don't think so. I think, these continued topics of, recession moving forward and what we're going to see this next year. I tend to agree. I mean, we're not getting a lot of great advice for the employees out there. We need to be very cautious. We need to be defensive. The next several months and so forth are going to be challenging. You need to make sure you're doing the right kind of asset allocation. You're setting cash on the sideline if you have it, and being prepared to take care of opportunities when they exist.
Ted, I know you like cash. Can you tell me why? And does this have anything to do with the Fed? And if it doesn't, can you tell me what you're expecting from the Fed next year as well in your answer?
Well, it had something to do with the Fed in terms of if you looked at what they did in 20 and 21, that's really what caused this, what I consider a super bubble. I mean, I thought 98, 99 were really, really overpriced, but they weren't anything compared to 2021. So it wasn't surprising when you get 2 or 3 standard deviations above the norm, you're going to get some setback somewhere. And so it didn't surprise us. And so for us, when I say cash, we have it in really, really short-term treasuries, 90 days or so. So that's what I'm saying when referred to cash. But we came into the year with that. So, we haven't really changed that much. I think the worst in terms of earnings and that sort of thing for public companies is still ahead. I see the first and second quarter being very, very poor comparisons. And I don't think that's priced in the market right here.
Do you agree with that assessment, Brett? And sticking with the theme of cash, if you have some on the sidelines, where are you allocating it early into the new year?
Yeah, I have to agree. I think that you really have to be extremely cautious. We're doing very much the same thing. A lot of short-term treasuries right now. And taking advantage of the higher interest rates. I mean, we don't necessarily like that and like what the Fed is doing, kind of pushing us towards this recessionary issue. I agree, we've got these earnings challenges. So you really just have to look for the companies that are heavily beat up, that have had, not great years, be looking closely at those earnings statements and so forth, and find, where it makes sense, and don't be in any rush. I always stick to more of the traditional set of good asset allocation, find sectors that have opportunity to be defensive right now, and kind of work our way through this, and really just not try and time the market. Have a good plan and work with an advisor to set that plan up.
Ted, what does it take for you to get bullish in the new year?
Well, yeah, I think you're going to have to get the earnings to a point. I'll give you an example. Average on the street for the S&P this 23 is around $230, 231, and we think it's probably going to come in somewhere between 190 and maybe 200 at the most. And so there's a lot of adjusting to go on. So if you look at forward multiples right now, they're still relatively high, even with those numbers. But when you adjust for what we're going to see, I think you have to get to a point for us to where, we really get it washed out pretty good. I mean, it's interesting to me that I haven't seen so many people, nobody's been too worried about this year, even though they've been beat up pretty good. It's kind of interesting to me. They don't have a tendency to think much about it. So we think they're going to have to get to a point where they're going to have to think about it.
All right, we'll have to leave it there, gentlemen. Brett Gottlieb, Ted Oakley, good to see you both. Merry Christmas.
Same to you.
All right, White House Chief Economist Jared Bernstein issuing a stern warning to Republicans who are threatening to use the debt ceiling as a negotiating tool. Very own Jen Schomburger spoke with Bernstein. Jen, good to see you. What did he tell you?
Good afternoon, Dave. Good to see you. President Biden's chief economist, Jared Bernstein, told me in an interview Thursday at the White House, with the economy in transition and headwinds like rising interest rates, now is not the time for Republicans to use the debt ceiling as a negotiating tool. Bernstein told me, quote, "It's always an absolute awful time to fool around with the debt ceiling the way the Republicans have been talking about, but it's even worse now. We've been talking about an economy that's in transition, headwinds which are real. There are obviously risks of different landing scenarios. This is just the absolute worst moment to contemplate own goals. House Republicans who gained control of the lower chamber in January are expected to use the nation's borrowing limit as leverage to push substantial spending cuts, setting up the potential for a standoff that could rattle markets. Several Republicans have said straight up they would oppose raising the borrowing limit if their demands were not met. Bernstein stressed weaponizing the debt ceiling to achieve spending goals is, quote, the height of irresponsibility, underscoring the reason the debt ceiling needs to be raised is to pay for spending that Congress has already authorized. In prior years, stalemates over the debt limit led to government shutdowns, plunging markets, and in 2011, an unprecedented downgrade of the nation's credit rating. Bernstein doesn't think a recession is, quote, inevitable next year, though he does see the economy and the job market slowing. The debt limit is expected to be reached sometime next year. Dave?
Would love to hear Kevin McCarthy's New Year's resolution. He is in a tricky spot. Jen, thanks so much. Appreciate that.
Thank you.
Coming up, it's been a brutal year for the housing market, but mortgage rates are showing some signs things could be looking up in 23. We'll break it all down for you after the break.
November new home sales released this morning, showing a slight uptick in sales compared to October, up 5.8%, but down 15.3% compared to November of 2021. Supporting the monthly uptick, mortgage rates did fall recently over 6 consecutive weeks, according to Freddie Mac, now sitting at 6.27% and for a 30-year mortgage. What can we expect for this market in 2023? We need to bring in our next guest to get his perspective. Ben Miller, Fundrise co-founder and CEO. Ben, how are you viewing this latest downtick in mortgage rates? Does this have any lasting support for the market? And just wondering what your fundamental drivers are right now.
Yeah, I think we're getting close to the bottom in credit markets. So what happened was interest rates and credit markets really drove down the housing prices. They drove down housing prices because mortgages and interest rates became so expensive. And now that you see the 30-year Treasury, the 10-year Treasury, all mortgage rates basically falling and spreads falling as well. I mean, like the spreads are tightening. I think we're going to cycle into the capital markets opening up in Q1, and that will restart the housing market in probably late 2Q is what my expectation is.
Where do you think rates will kind of settle in, let's say middle of next year? And to your point, do you think that'll be enough to get buyers, sellers, and investors off the sideline? At what point do rates get people back in?
Yeah, I mean, I think it's sooner than people might expect. We work across the United States. We own 20,000 residential units. We're buying thousands of units across every quarter. And we're seeing already an inflection point in the last couple of weeks. We work with 8 of the top 15 biggest home builders in the country. We're seeing a bottom in new home construction pricing. So I think it's going to surprise people. The way things move these days, everything was faster than it ever did before. And so I think mortgage rates, I mean, eventually they end up in the low 5s. That's where, today they're, let's say, Treasuries are going to be 3% long-term Treasury, 175 bips above that. It's going to be around 5. And I think that is very healthy for the market.
We were just showing some of your top primary markets on the screen there. Wondering if you could go break down some of the trends that you're seeing with regard to some of these regions and maybe add on some of the secondary markets too that you're tracking.
Yeah, the funny thing about real estate's a levered investment on GDP. So you lever the country's growth, the state's growth, the city's growth, and the neighborhood. And so those cities listed there essentially make up 1 million people a year of population growth. Last year, Texas, Florida, North Carolina, South Carolina, those 4 states grew 1 million people in 1 year, and the whole country only grew 1.3 million people. So it's something like 75% of population growth happened in a very few number of states, and in those states, it happened in 8 cities. So 8 cities are making up probably 65% of all the growth in the country. And so you want to be investing in those cities, and then you want to be investing in the best neighborhoods in those cities. And then you're just getting, most of the United States' growth in a concentrated geography.
Yeah, Ben, it's remarkable, the dominance of the southeastern region, in particular North and South Carolina, on everyone's top 10 list for next year. You talk about regions there. What about sectors that you think are sure to boom in 23?
Well, I gotta say sure, because at the beginning of this year, Ukraine war happened. So but I would say that residential is, I think by the end of Q1, Q2, approximately, we're going to have seen the bottom, and residential is going to make a roaring turn back sometime mid next year. And industrial, I mean, the winners keep on winning. That's the nature of tech, that's the nature of real estate. The best markets and the best assets keep winning. And then office and retail are going to just continue to decline. I mean, we have a generational decline or obsolescence in essentially half of the real estate market, which is office and retail.
That's really interesting. I like these generational trends. They kind of play out over the secular time frame, maybe over a decade or more. Just wondering, how do you see the inventory situation right now with respect to satisfying the demand by millennials and now Gen Zs, forming new families, and that trend, and how that may evolve in the coming decade?
Yeah, generational trend, that's exactly the right way to think about it, because if you take industrial in the 80s was like, not a hot part of the economy. And then e-commerce really transformed it. And e-commerce has been a generational change in how people shop, how people think about commerce. And the same thing's happening with residential. Work from home revolution is changing the way people live and work. And it's accruing to the benefit of single family housing most of all. And so you're talking about $1 trillion of office value being transferred to residential rental real estate, probably mostly. And that's like a 10, 15, 20-year trend. And I think it's going to be the biggest thing happening in real estate this decade.
All right, we're going to have to look out for that. Really appreciate your time here, Ben Miller. All right, coming up this season, is it the season to get a raise? That's what our next guest says. She's going to explain on the other side of this break.
People making money through e-commerce platforms will have one less headache to worry about this tax season. The IRS announcing it is giving Americans a one-year reprieve on new tax reporting requirements, a rule requiring platforms to inform the IRS of individuals making more than $600 a year in online business transactions. Joining us now, Nora Yusuf, RBC Wealth Management Senior Vice President. Nice to see you. So why, in your estimation, did the IRS make this change? Is there some acknowledgement that maybe this dollar amount is too low? And what does this mean for taxpayers?
You know, I don't expect that amount to change, but it does allow taxpayers to prepare and get a better understanding of the new reporting requirements. And in anticipation, this is really making it so that the IRS can better get a grip over unreported business income.
I'm wondering about the timing here. The Congress just passed a $1.7 trillion spending package. We also, well, this is a day before a holiday. You really can't release news on any less busy day of the year than this, except for maybe right before New Year's. Just wondering if there's anything to read in terms of the timing of this announcement.
You know, I think it's year end, that there was a year end scramble. I'm sure they were getting flooded with questions. And so really, in the grand scheme of things, this doesn't really change income that is truly taxable, just what information the IRS will receive. So I am really telling people that they still need to track and report all income that comes through. When it comes to the IRS, you really don't want to mess around.
All right, let's get into some of your financial advice for 23. And I love this one. Ask for a raise, but do it now. Why?
Yeah, well, unemployment is as low as 3.7%. Demand for workers exceeds the number of unemployed people looking for work. So for now, at least, the employee, not the employer, has the upper hand to demand more pay. And I'd say do this now. Don't wait for the annual review. One, budgeting and forecasting goes on around now for businesses. Plus, you likely have a limited window of time here. This strong labor market is a case where good news is bad news, as the Fed is targeting employment in an effort to lower wage growth, inevitably translating to job loss, which we're already starting to see layoffs extend beyond tech.
All right, speaking of good news, good news, the year's almost over. Bad news, we're still stuck in our 401ks. Just wondering what people can do. I'm talking about tax loss harvesting. It's still available for another few days. We got the markets open Tuesday, Wednesday, Thursday, Friday next week. Any advice there?
Yeah, well, 2022 wasn't exactly a year of gains. And no matter what's going on in the economy, we're always conditioning ourselves to sniff out the opportunity for clients, whether it's fixed income, locking in higher rates for longer, or discounts in the equity market. On taxes, you want to make sure you are harvesting your losses. So what does that mean? Any losses taken this year, including in crypto, can offset capital gains up to $3,000 in ordinary offset gains and $3,000 in ordinary income on your 2022 tax return. Oh, and if you still have some losses, you can carry those losses over to offset future capital gains in future years. Now, this is important because you want to keep a long picture and have an understanding of recessions. And the good thing about recessions is that they don't really last much longer on average than a year and a half, and they are always followed by booming years in the stock market where you will likely have gains. And of course, past performance is no guarantee of future performance.
All right, sage advice. Got to leave it there. Always appreciate you stopping by, Nora Yusuf.
Sure.
Santa, like millions of American homeowners, has increased home equity that he can tap into right now. According to Zillow, Kris Kringle's North Pole property has gained 12% in value over the last year. Santa's pad has 3 bedrooms and 2 bathrooms and 25 acres of land. It was built in the 1800s, but was recently renovated and is now worth $1.15 million. Dave, I'm looking at this pretty nice picture here. I guess Santa's enjoyed some price appreciation. Looks like a real home here.
Oh, it's gorgeous, man. I tell you what, 12% up in this market. I mean, that's phenomenal performance when most homes, if they're lucky, are up about 3 or 4%. So must be a little Santa factor built into that. He's up 77% in the last 5 years. So Santa is performing. Do you think there's a Peloton on this thing? Like, do you think Santa does a little exercise? What are the extras? Does Santa go for a little hot tub? What goes on there?
You know, I saw a laptop, so I'm assuming there is fully functioning utilities there, including electricity. I don't know if there's a Tesla power wall. I wouldn't be surprised if there's one made by elves or what have you. I guess I'm just kind of spitballing here. I am impressed with the property. I love the log cabin look, and I can almost smell those cookies coming out of the oven right now. Now, I do see Kris Kringle there walking. I don't know if that's the actual man or an actor who was actually paid to play the part here. Dave, any thoughts on this?
No, I was definitely the real guy, okay? We don't mess around with Santa. we want the kids to make sure that Santa is going to make his deliveries. But I just think this is an excellent investment. I think if I were to sell this home, I would definitely showcase, as your point, that log cabin aspect. Look at the kicks here, right next to the Santa boots. I did not imagine Santa having any need for tennis shoes. The big fella doesn't look like he gets a lot of exercise, so I'm not really sure why he has those tennis shoes, because he's put on a few pounds in the last couple of years.
Hence
I
the
thought
Peloton.
maybe some Uggs. I could see
Uggs.
Santa in some Uggs when he's not wearing the boots.
I'm pretty sure the elves invented those in the mid-90s, and that's why I was forced to look at them during my after high school years there. All right, we have to check the markets here, so let's go to the Wi-Fi Interactive and see how we closed out the week. Dow up 0.5% today, but I'm going to check on the 5-day performance here. We do have the Dow up about 86 basis points, so not even 1% for the week. We also have the S&P 500 up 0.5%. Now, for the week, that is underwater. 3rd week in a row that it is underwater. And then the Nasdaq up about 0.2% for the day, but down 2% for the week. And just a reminder, the Santa Claus rally starts today. It carries on next week, Tuesday, Wednesday, Thursday, Friday, and then the first 2 days of the new year. That's usually how it goes down. So in the meantime, let's just do a recap of the sector action for today. We have energy up 3%, followed by utilities, communication services, real estate. You can see everything in the green there. Healthcare up about 0.6%, but just about equal.
All right, what's your stock story of the week, my friend?
Stock story of the week, Tesla.
Oh, I was going to take Tesla.
You're always going to take Tesla.
Okay, go.
It's always going to be Tesla and Apple in a week like this because Tesla has just been this unrelenting bear case right now. Everybody's been buying or trying to buy that falling knife, and there are a lot of reasons why, valuation-wise, people should be stepping in here. But if Elon is still selling, and hopefully he's done, we're going to have to see if that plays out, Dave.
Yeah, down 18% of the week, down 30% of the month, worst month ever for Tesla. Somebody can't wait for 2023. And
I almost can't either.
Elon Musk. Yeah, I'll give you that. Merry Christmas, my friend. That'll do it for Yahoo Finance Live today. Happy holidays. Merry Christmas to all of you. We'll be back Tuesday, 3 p.m. Eastern Time for all your coverage leading up to and after the merry closing bell. Look at those two. Yeah, baby. I got that elf hat. I am a bit of an elf.
I hope I'm getting a Peloton.
You gained some weight, dude.
I know.
Merry Christmas, everybody.